Hello there and welcome to my channel. In this particular video, we are going to continue our discussion on financial modeling series, and we are going to specifically consider how to build the debt schedule in this particular video and also complete our entire financial model so that in the next video we can move on to the next part of the series, which is evaluation analysis. All right, so quickly, let us look at what we have covered so far in the series. So we are looking at modeling the financial statements of Amazon, and so far we have been able to model the income statement from the total net sales through the operating expenses through to EBITDA. We have been able to model our depreciation and amortization using the PPA schedule, as we have seen in our previous videos. And also we have been able to determine the EBIT, which is the earnings before interest and tax. And we have left interest income and interest expenses blank, as you can see here, with the hope that when we complete the the debt schedule, we will be able to finish this particular area as well. So that is what we have been able to do about the income statement of Amazon. Every other thing has been completed, and so that is what is left for us to do. Then we moved on to our cash flow statement, where we were able to complete the cash flow statement after we completed our working capital schedule, and so we have been able to complete our cash flow statement as well. And it's left with a few items here. So we are left with the financing activities section here, where we left our debt items. So we are talking about proceeds from short-term debts, repayment of short-term debts, proceeds from long-term debts, as well as repayment of long-term debts, and the principal repayment of finance leases and other financing obligations. So we've left these blank. Also, I'm hoping that we'll be able to complete it once we are done with our debt schedule. And finally, we moved on to the balance sheet. And with the balance sheet, which we have completed in our last video, we were able to also derive a lot of the figures here. But at the end of the video, we got to realize that the balance sheet for the forecast periods didn't balance. So we have our balance check here giving us a difference of 3,502. All right, so that is what we are having there. And so this particular video, we are coming to, first of all, look at the balance sheet again and try to balance it before moving on to build our debt schedule. So please, if this is your first time on my channel, make sure you have subscribed to the channel and also consider liking the video and share with others so they can also watch it and benefit from it. All right, so as I said in the beginning of the series, when it comes to building the financial model, initially we make assumptions, simplified assumptions. All right, and I said that it is very difficult for us to obtain all the information we need before building our model. So what we typically do is that we make our assumptions, and then as and when we obtain some relevant information, then we can tweak these assumptions to reflect the reality. And so we are going to do that for our balance sheet here. So when you look at the balance sheet, we actually assumed initially that operating leases and goodwill is going to remain unchanged, or is going to remain flat, which is zero, going forward. But when you look at the historical data here, you could see that it will be very hard for these figures to be zero going forward. And so quickly, we can make certain adjustments here. And again, this is a simplifying assumption. Now, in my previous video, when we're modeling the balance sheet, we understood that we use the cash flow statement to drive the balance sheet. And so what we came to understand is that we do not have items in the cash flow statement that are relating to operating leases and goodwill, and hence it was difficult for us to do that. But as the norm was, we were taking the previous year figure, which is the last year historical figure, which is the 2023 figure, and adjusting them for our figures within the cash flow statement. And since we do not have any figures for our operating leases and goodwill, what we are going to do is to assume that the figures going forward is going to be the last year figure for our historical um, year. So this is what I mean. For operating leases, we are going to assume that this is going to continue for the foreseeable future, as well as for goodwill. We are going to expect that this is going to continue going forward. And so I can copy this across. All right. And now that it is a formula which is linking to another figure, we can change the font to black. And so I'll come to my under the homes tab here, and come to my font color and change it to automatic, which is black. All right. Then let's scroll down and look at what we can change here as well. Now, when it comes to common stock and additional paid-in capital, we are going to do the same assumption. So this is expected to continue from the last period, as well as our treasury stock at cost, also going to continue like that. And so we can copy this and copy it across. All right, and then also change the font color to automatic, which is black. All right, so with this, we are able to kind of deal with all the line items within our balance sheet. But still, you could realize that the balance sheet has not balanced. It is still left with 503. Now, when it comes to balancing an unbalanced balance sheet, there are a few things to look at. Now, using the understanding that our balance sheet items increase or decrease based on how much cash is obtained or spent, it is easy for us to understand that unbalanced balance sheet occurs when there is a mismatch between our cash flow statement and the particular balance sheet item. So more specifically, there are four main reasons why a balance sheet may not balance or may remain unbalanced. Now, the first one is that there is a line item in the cash flow statement that has not been linked to the balance sheet. Often, especially when the cash flow statements have a lot of non-standard line items, which means that those items exist in the cash flow statement but not in the balance sheet. Okay, so that can happen and cause our balance sheet not to balance. The second one is where there is a line item in the cash flow statement that has been treated more than once in the balance sheet. Thirdly, we can also attribute an unbalanced balance sheet to the fact that a line item in the cash flow statement is linked to the correct balance sheet item, but it is moving in the balance sheet item in the wrong direction. Okay, or that the line item is pulling from the wrong year. All right, that can also cause the balance sheet to not balance. Now, this is where having a standard structure of formulas can be very useful. Now, when you look at our balance sheet, every forecast item here was obtained using the formula, the previous year figure, and we added or subtracted a related cash flow item from the cash flow statement. That was what we did. Almost all the items. All right, that was what we did. So as you can see, our marketing securities, this is the previous year figure, our cash flow statements. Now with the assets, we typically pick the previous year balance and we subtract the cash flow statement item. That is for assets. All right, when you look at our accounts receivable, it's the same thing we did. For our property, plant, and equipment, it was the same thing we did. All the assets, all right. Then when you come down to the liabilities and stockholders' equity, is the opposite. we typically added our related items from the cash flow statement. All right, so this is where the formula is very helpful for you to understand exactly what is driving your balance sheet, so that in case it is um, in an unbalanced position, you know exactly what to check. All right, now I have gone through this particular balance sheet carefully, and I realized that we have done everything correctly. All right, and then a fourth reason why the balance sheet will not balance is due to casting errors. And with casting errors, we are talking about our additions and subtractions. So where you do not add your figures very well, then you may have your balance sheet being unbalanced. Now, with all this, we have done everything correctly in my previous video. And so I have identified that Amazon has not actually linked the correct cash flow balance from the cash flow statement onto the balance sheet, which is a cause of concern. So when you come to on the balance sheet, the cash balance is 73,387. That is the historical cash balance for 2023 actual year. Is 73,387. This is supposed to be the same as our cash and cash equivalent and restricted cash at the end of the period on the cash flow statement in 2023. All right, but this is not the case. So when you come here, this is 73,890. But when you come to the balance sheet, this is 73,387. Now, coincidentally, the difference between those two figures is equal to the um, the balancing difference we are seeing at the top here, which is 503. So let me prove that. So let's come to the cash flow statement, and then we are going to do this. So we have our cash balance of 2023. I'm going to subtract that. I'm going to subtract that of the one on the balance sheet, which is 2023 cash and cash equivalent, and this is 503. And so what we can do to balance our balance sheet for now is to subtract this 503 from this particular figure here. All right, and that is going to flow through the entire model. So this is what I mean. We are going to subtract 503 from that, and this is going to balance our balance sheet. So the error is technically not coming from us. It is coming from the historical financial statements. All right. Now, again, remember, this is for academic purposes, and so I'm issuing this disclaimer that Amazon has nothing to do with what I am doing here. All right, maybe this particular difference of 503 is included in another line item within the financial statements, and so until I research about that and come to a reasonable conclusion, I cannot state specifically that Amazon has made a mistake in preparing its financial statements. All right, I do not have all the information about that, but for the purpose of balancing our balance sheet, we can do that for now, pending investigations into the 10K. All right, so that is what I want us to quickly look at. Then, now that we have our balance sheet balanced, now this is very important task before we move on to building our debt schedule. All right, because there is a problem of circular references when it comes to the debt schedule, and so having your balance sheet balanced is very important in order not to complicate issues when after building your debt schedule. All right, now before we come to the debt schedule, I want us to also come to the cash flow statement and do some measures here. All right, so the measures I want us to do is when you look at coming to the financing activities section here, when you look at the proceeds from short-term debts and other, as well as repayment of short-term debts and other, these are actually relating to short-term debts. And so what you can do is we can merge these two together. All right, and then the same thing applies to the long-term debt. Now the proceeds here is talking about issuance of long-term debts, and the repayment is talking about payment, payback, or pay down of our long-term debt. So let's merge these two items together and see what you are going to have. So I'm going to insert an extra row underneath my short-term debt two items here, and also insert another row underneath my long-term debt line items there as well. So here I'm going to have um, issuances. So let me see, proceeds slash repayments of short-term debt and other. All right, and then I also come here and have proceeds slash repayment of long-term debt. So let me kindly correct this. So short-term debt and long-term debt. And then I can be able to add those two items together. So this is going to be equal to alt equals, and this should be 36. Hit enter, and then I can copy this to the right using R. Then what I'm going to do is to copy and paste this as values. All right, these are currently formless. All right, so I'm going to copy and paste them as values. So I'm going to select this, holding my arrow, I selected those, and then I'm going to hit Control C to copy, and I'll paste as values. So I'm going to hit Control Alt V, and that's going to open my paste special. Then I'll tap or I'll press V on my keyboard, and that is going to select values, as you can see here, and then I'll hit enter. So this has converted my figures into values for me. So with that, I can select these two using my shift. I can select the second one concurrently and select delete and delete those. And then for this, I will do the same thing. I'll have alt equals, and I'm going to amend the sum to include only B37 up to B38. So I'll hit enter, and then I can copy my formula across using Control R and do the same thing here. So I'm going to copy and paste special, V, enter, and that will paste that for me, and then I can delete these two items as well. I can delete these two items. Now, to check whether what we have done is running through the model successfully, we need to quickly go to the balance sheet and see if the balance sheet is working properly. So we can see a reference error there, cell reference error, which means that our formula, which is here, is referencing, which is the long-term debt here, is referencing the two items we have seen there. So as you can see from the formula bar here, you could see that we have two items being referenced from the cash flow statement, but now we have one. And so what you're going to do is to rebuild this particular formula. So this is going to be equal to our previous year figure, as we have done in the previous video. And then I'm going to add, remember this is a liability, so add the related item from our cash flow statement. So this is long term, and so I'm going to select the empty space here and hit enter, and then I can copy this across using Control R, and as soon as I do that, the reference error is gone. All right, so that is that. So I believe you are done with the adjustments we need to make to both the cash flow statement and the balance sheet. Now, this is how the balance sheet and the cash flow statements are also interrelated. Now, quickly, for those of us who are new to accounting, let me show you some of the ways that these three financial statements are linked together. All right, so first of all, we prepare the income statement. All right, so the income statement is going to result in the bottom line, which we call the total net income. as reported, as you can see here. All right, so we have net income for the entire period, and then this net income is going to be transferred to the cash flow statement. This net income is going to be transferred to the cash flow statement, and this is transferred as part of our operating activities, as you can see, net income or loss. So that is what we are having here. So it's the same thing we transfer. So when you look at this, this is referencing income statement, as you can see there. So that is that. And then when you come to the balance sheet, this in the cash flow statement, it's the bottom line is also our cash balance at the end of the period, right? Our cash balance or cash equivalent and restricted cash at the end of the period. So these amounts are also transferred to the balance sheet as our cash balances, cash and cash equivalent balances at the top of the balance sheet here, as you can see, under current assets. So we have cash and cash equivalents, and these are supposed to be referencing the cash flow statement. All right. So basically, this is how these three financial statements are linked together. This is for those who are new to accounting, and for financial modeling purposes, we could see that we could actually use the cash flow statement to model the balance sheet as well. So anything we do in the cash flow statement is going to directly affect our balance sheet items as well. All right, so that is for those who are still new to accounting. And if you want to make a very good financial modeler, it is imperative that you understand accounting fundamentals. And I can state that you are on the right channel. So because on this channel, I've covered many of those accounting fundamental issues, such as double entry, how to extract the trial balance, and prepare simple financial statements to advanced financial statements, including consolidated financial statements. So you can check all those videos out. All right. Now let's come to our debt schedule. So the debt schedule basically is essentially built to track every major type of debt a company has and its associated interest and payment schedule for each. All right. Now, the debt schedule also helps us to track down the cash available that could be used to pay down those debts and any interest income that could be generated from the cash or cash equivalents available at the end of the period. Now, this is the last schedule that we built because of the issue of the secular references associated with it. And that is why I said that we need to ensure that the balance sheet is in balance before we attempt building the debt schedule. Per the format I am using in this particular video, when you check my other videos, you could see that I have built the debt schedule first before preparing the balance sheet or before modeling the balance sheet. So this is an alternative way of treating or modeling the balance sheet. All right. So as I said, and I continue to say, that there is no one size fits all situation when it comes to financial modeling. All right. So quickly, let's look at the structure of the debt schedule. As you can see, so I'm going to leave this structure in the video description so you can download it and follow along. So at the top, we have cash available to pay down debt, and under that we have the opening cash balance at the end of the or at the beginning of the period. We have cash flow before debt pay down. We have restricted or minimum cash amount. I'm going to explain these as we move along. Then we have total cash balance available to pay down debt. Then we have our short-term liabilities. Now we have in the balance sheet of Amazon, we could identify three major types of liabilities. Right? We have short-term liabilities, we have long-term liabilities, as well as long-term lease liabilities. So what the debt schedule essentially helping us to do is to know the amount of debt of these categories of liabilities we have. All right. So when you look at the debt schedule, you could see that we have the three categories of debt. So we have short-term debt or short-term liabilities. Then the second section is long-term debt. And then the third one is our long-term lease liabilities. Now, when you look at the balance sheet, we have other long-term debt. All right, we are not going to treat that other long-term liabilities. We don't know the composition of this, and so we are going to leave that. All right. So those are the three major kinds of debt we are going to deal with within our debt schedule. The three major categories of debt. Okay, so that is what we are having there. So with the short-term debt, or for each category of debt, we are looking at the opening balance, we are looking at mandatory issuance or payments, and then we also have non-mandatory issuance or payments. Then we have a closing balance. Then we'll determine from the 10K of Amazon the short-term interest, their interest rates, and we use the interest rate to determine their interest expenses. So it's the same thing we are going to do for each of the three categories of debt. So as you can see, we have for long-term debt, we have the opening balance, mandatory issuance or payments, non-mandatory issuance or payments, and then we have our closing balance. We have the long-term debt interest rate, and then we are going to calculate that. We are going to use that to calculate our interest expense. All right, so this is actually expense. All right, as you can see, it's the same thing we've repeated for our long-term debt. Then at the bottom, we are going to add all the issuances or repayments together. You're also going to add our total interest expense, which is actually going to be used to fill out the remaining part of our cash flow statement and our interest income as well. So let us look at that. Right, so let's look at how to model the debt schedule. Now, you should note that when it comes to the debt schedule, we don't deal with the historical session much. We are only going to deal with their last balances of each of these items. The last balances of each of these items. And so we are going to pick the total cash available at the end of the period. So that is actually at the bottom here. So this is our cash balance. So I'm going to bold in that at the end of the period. And I'm going to pick that of 2023. So I'll have equals, and I'll go to my, this information can be found both within the cash flow statement or the balance sheet. So let's come to the balance sheet and pick that. And that is going to be my cash and cash equivalent, 73,387. So I'll pick that, format this as an accounting figure with 0 decimal places. Also resize this. All right. And this same amount is going to be the opening balance at the beginning of 2024 forecast period. So I'm going to go down there and link this particular amount, as you can see. And we are going to do same for all the categories that we are having here. All right. Now let's come to the short-term liabilities. Now, when you look at the balance sheets of Amazon, the short-term liabilities has not been given directly. All right. And so we need to do a bit of digging to be able to find out our short-term liability figures. And it doesn't mean that these have not been included within the balance sheet. It is hidden within one of the line items that are existing within our current liabilities here. And so in order to do that, we can do a quick research on our 10K. And so quickly, I'm going to my 10K here. And this is my 10K. When you search when you do a word search, such as the word debt, and you scroll down on page 58 of the 10K, you come across this information. Now, when you look at the bottom of the table I'm looking at, this table is a summary of the debts of Amazon, all right, with their effective interest rates and their balances at the end of 2022 and 2023, respectively. Now, when you look at the bottom here, before the total long-term debt here, you see less current portion of long-term debt, right? And for 2023, it is 8,494. And so we know that the balance at the end of 2023 is actually 8,494. So quickly, I'll come here to my debt schedule, and I'm going to input 494 here. All right. I'm going to input that there. And this is going to be the opening balance in the 2024 forecast period. And so I'm going to hit this and have that. And then I can copy this across using Control R. Let me come back to my cash section here and also copy this opening balance figure across using Control R. All right. Then we also have our long-term debt. I'm going to link that from my balance sheet. So I'll come to my balance sheet, come to the long-term liabilities section, and I'm going to pick my long-term debt, which is 58,314 there. And I'll come back to the opening balance and link that to my closing balance. The assumption is that the closing balance of the previous period becomes the opening balance of the next period. So I'll copy this across using Control R. I'm going to do the same for my long-term lease liabilities. So come to my balance sheet and I'm going to have this linked to that place and also have my opening balance right here. Link that and copy it to R using Control R. All right, so that is the first thing we want to do. Then we can proceed. All right, so we are going to leave the cash available to pay down debt section here for a later period, and we are going to move straight to the short-term liabilities. All right, so we have the mandatory issuances, and or repayments or payments, and then we also have the non-mandatory issuance or repayments. So what this means is that in financial modeling, we often separate our debt issuances, that is raising of debt, and our debt repayments or retirement into two categories, which we are calling mandatory and non-mandatory. And the mandatory issues or pay downs are those that have been planned or scheduled. Right? So an example is an annual interest and principal repayment as a contract agreement. And then the non-mandatory issuance or retirement is one that is beyond the contractual requirements of the debt. For instance, where a cash surplus exists, the company may decide to pay down debt if allowed to do so by the debt provider. This is usually used in revolving lines of credit, where one would pay down the debt if there is cash surplus. All right, so that is that. Now, in financial modeling, since mandatory payments are scheduled or planned, we typically input them as hard code figures based on the contract terms, whereas the non-mandatory payments are typically based on a formula created that compares our cash available to outstanding debt balance. That if there is excess cash, we will automatically pay down our debt. So that is the distinction between the mandatory and then a non-mandatory issuance and debt repayment. All right, so my research on the 10K does not reveal any mandatory issuances or repayments of our short-term debts. So I'm going to put 0 here and also 0 here. All right, and then the total is going to be the summation of the two. So I'm going to have alt equals and sum those two, and then I can copy this across using Control R. Then with the interest, we first of all need to determine the interest rate debt, short-term debt. And my research on the 10K, okay, again, when you come to the 10K and you search for debt, you will see that we have, these are for long-term debts, all right? But when you read the notes to the table here, you will realize that the company has quoted 4.5% for our short-term debts, all right? When you scroll down, you see this. Our short-term debt is included within the accrued expenses and other on our consolidated balance sheet and had a weighted average effective interest rate, including insurance cost of 4.5%. So that is the rate we are going to use. So quickly we can come here and input our rate here, 4.5%. All right, I'm going to italicize that and copy it across using Control R. And then with that, I can calculate my short-term debt interest rate. And that is going to be equal to, I'm going to pick the average of these two figures. The reason we are picking the average is because we don't know exactly which period this interest is going to be paid, whether it's going to be paid mid-year or at the end of the year. And so using the average figure is going to give us, or is going to get us a more reliable figure for our interest rates. All right, so I'm going to have equals average. I'm going to hit tab to select that, and I'm going to select these two items here, close my parentheses, and multiply that by my interest rate, which is 4.5%. And then I can copy this across using Control R. All right, so that is that for our short-term liabilities. Then we come to our long-term debt. Now, with the mandatory issuances, this has been provided within the 10K of Amazon. And so quickly, let's go back to the 10K, and we can find now just below the table we have previously seen, you will see this table here showing as of December 31st, 2023, future principal payments for our long-term debt were as follows. All right, so you can see 2024 giving us 8,500, 2025 is 5,286, 2026 is giving, 2027 is giving, 2028 is giving, and thereafter is also giving us this. So fortunately for us, we are working up to 2028. So we are going to pick the figures from the beginning, from 2024 through 2028. So I have already noted those figures, and so quickly I'm going to input them into the mandatory session. So let's come back to Excel and input those figures. So I have 8,500. And remember, these are payments, okay? And so they are supposed to be negative. Payments are indicated as negative. So I'll hit enter there. I'll come here as well and input that of 2025, which is 5286. Sorry, this is negative. I also have negative 3142. I have negative 8750. And then finally, for 2028, it is 2250 or 2250. So those are our mandatory payments. All right. And then for the non-mandatory, we can make it zero. We can make it zero for now. And then I can add these three items together, hit enter, and copy my formula across using Control R. All right. Then again, the 10K reveals that in the same debt table we have previously seen, you could see that we have a table or a range of effective interest rates. Okay, these are our effective interest rates here. And for between 2024 and 2032, you could see the effective rates ranging from 4.61% to 4.83%. So we want to be conservative enough, and so we are going to use the 4.83%. So I can come to my Excel, and under the long-term debt interest rate, I'm going to put 4.83% right there. So this can be 4.8. Then I can copy this across using Control R. And my interest is again going to be the average of the two balances for 2023 actual year and the 2024 estimate. All right, so I have average and select these two items, close my parentheses, multiplied by the interest rate, hit enter, and then format this to 0 decimal places. and I can copy the formula across using Control R. Right. So we are making headway. And then finally, for my long-term lease liabilities, I am going to have 0 for my mandatory issuances, which, because we do not have any information on that on the 10K, and the non-mandatory, I'm not going to do that for now. So I can add this, sum this together, and copy my formula across using Control R. Right. Then for my long-term lease, interest rate, I have found out from the 10K to be 3.1%. Okay. And so what I'll do first is to format here as a percentage with 1 decimal place. All right. So I can now put in my figure there. So 3.1, and I can italicize this using Control I, and I can copy it across using Control R, sorry. And then I can calculate my interest expense on the lease liability as well. So this is going to be equal to the average of our closing balances, close my parentheses, and multiply by the interest rate, and hit enter. And also format this as to 0 decimal places, and resize this and copy this across using Control R. Right, so we are done with our 3 main debts. All right, so that is that. So with this, we can now find our total issuances or repayments, and that is going to be equal to the summation of all the issuances and repayments. And so you're going to start from the short-term liabilities. You are going to add these two together. So I'll have this plus that of my long-term debts, add the mandatory and the non-mandatory, come to my long-term lease liabilities, add my mandatory as well as the non-mandatory, and hit enter. Then I can copy this across quickly, and then quickly come here, and copy this also across using Control R. All right, so we are making very nice headway. And then I can also sum the total interest expenses here, or the total interest expense. So you are going to have the summation of all of that. So I'll go back to the top, pick that of my short-term interest expense, add it to that of my long-term interest expense, and then finally to my lease interest expense. And then I can copy this also across using Control R. Great. So with this, we can now go back to the top and look at the cash available to pay down debt. Right. Now, remember that the debt schedule is basically helping us to determine the amount of cash available to pay down our debts. And also, it measures how much cash is generated or paid, excluding cash raised or paid our debts. So this is all cash available to pay down debt. All right, that is what we are going to do. So the first item is our cash balance, which we have done already. The second one is cash flow before debt pay down. Cash flow before debt pay down, and this information can be derived from our cash flow statement. So quickly, let's go back to our cash flow statement and have a supplementary information here. So I'm going to have supplementary data, and this supplementary data is going to be cash available to pay down debt. cash available to pay down debts. So I can bold in this, and this will be calculated. Now we are not interested in the historical years, and so I can intentionally leaving this blank. I can actually change the fill color to this light gray color there. Okay, this is too light, so let me change that to one that is a bit darker. So the cash available to pay down debt is essentially the cash we have generated over the period, excluding those coming from our debts. All right, so we are talking about the financing activities section of our cash flow statement. So all the cash flows coming from our debts is going to be excluded. And so what we are going to do is we can have equals. We are going to have the total cash flows from our operating activities. We are going to add that of investing activities, all right, which we have here. And I'm going to add all the cash flows within the financing activities that are not debt related. So the first one is common stock repurchased is there. And that is actually the only item that is not relating to debt. All the other items here are debt items. So I can hit my enter there. And I can copy this across using Control. And finally, okay, let me copy that across, Control R. Now you have to be very careful because there is an extra item, which is the currency effect on our cash and cash equivalents and restricted cash, which is here. So I'll add that and copy this across using Control R. All right, that is very important. Right, so let's go back to our debt schedule and now link that information from our cash flow statement. So I'll come here and link this, and then I can copy it across using Control R for the rest of the items. So let's see if this is referencing our cash flow. So this is very good. Now, because of the referencing to the other financial statements when we are dealing with our debt schedule, that is what results to the iterative calculation issues and its subsequent circular references that Excel is going to be notifying us very soon. So when it comes there, we are going to deal with how we work around references, circular references within our financial model. All right. Now there is the restricted or minimum cash balance here. So this minimum cash balance is a minimum amount that a company may want to keep at the end of the year. This is to cushion the company against any unnecessary cash shortfalls, etc. Okay, so the minimum cash balances vary from company to company and can be calculated as a percentage of various line items within our financial statement. This can be calculated as a percentage of our net sales, can be calculated as a percentage of operating capital or operating working capital, or even our total cash balance. All right. Now, when you look at the cash balance of Amazon, let's go to the balance sheet and see. When you look at the cash balances of Amazon, even historically, you could see that the balances are very huge. And so it is no surprise that in the 10K, there is no information relating to a minimum cash balance. Okay, but sorry, I'm actually looking at the wrong figure there. So this is our cash balances. All right, they are very huge. And so it is no surprise that Amazon doesn't keep any minimum cash balances or has not disclosed any minimum cash balances that it has to keep at the end of each year. But looking at the recent 2 years, 2022 and 2023, we can say that the minimum cash could be, and then taking into account this 36 year, which is a little lower, we can say that the minimum cash can be 30,000 or 35,000. Let's make it 35,000. So this is a simplified assumption we are making. So let's make it 35,000 there. So we are saying that at any point in time, Amazon will not be keeping or having a cash balance less than 35,000. I'm going to edit this as an accounting figure with 0 decimal places and resize this, and I can copy this across using Control R. Right, now our cash, total cash available debt, pay down debt. This is actually total cash available to pay down debt. It's going to be the summation of these three items. All right, and remember that this is a minimum cash, and so it's going to be a negative figure, because we are saying that at the end of the period our cash should not be less than this particular amount. So it should be a minimum amount and it should be a negative amount there. So I can copy this edit across using Control R. All right, so I can also copy my formula across using Control R. So that is how we deal with the debt schedule. Let me also copy this across using Control R. Copy this also across using Control R. All right, so we are almost done. Now the cash balance at the end of the period is going to be equal to our beginning of the year figure, which is at the top here. We are going to add the cash flow before debt pay down, which is here. And we are also going to add our total issuances of debt, total issuances or repayments of debt, which is at the bottom here. All right, and then I can hit enter. Then I can copy this across using Control R. All right. Now let's determine our interest income as well. Now the interest income is simply interest on cash held in short-term investments such as cash savings account, certificates of deposit, etc. Now the interest rate per Amazon's 10K information is around 2.60. So I can hard code this 2.60. So again, let us format this as a percentage first with 1 decimal place and input our 2% there. And then I can copy this across using Control R. And I'm going to have my interest income calculated in the same way as we have calculated our close my parentheses and multiply that by the percentage rate or the interest rate. And that is giving me that. I'm going to reduce the decimals to 0. And I can copy this across using Control R. So that is our interest income as well. Now, as a best practice, once again, we need to indicate that we have intentionally left these spaces blank. And so I'm going to do this for all the blank spaces. And then finally, I can do this for this portion as well. Okay, so that is fine. So we have all of that. Now, we want to look at now let's look at the income statement and link our interest amounts. All right, so this is the income statement, and within after our earnings before interest and tax, we have the two interest items here. So quickly, I'm going to link my debt schedule. So the first one is our interest income. So I'll come here and link that equals, come to my debt schedule and link up my interest income from here. And we have already seen the circular reference, where we are saying that there are one or more circular reference where a formula refers to its own cell, either directly or indirectly. This might cause them to calculate incorrectly. So the reason we are seeing this is because interest income, the information we used to calculate our interest income was coming partly from the income statement. Okay, and we use that information in our debt schedule. As I said, the referencing we are making to the financial statements is what is going to cause the circular reference within our model. So we are going to deal with this issue. So as you can see, this has given us 0. That is not an issue. We are going to rectify that in a moment. Then I also link my interest expense. So I'll come to my debt schedule and link my total interest expense here and hit enter. And I can format this as an accounting figure with 0 decimal places. I can have this and copy it across using control. So I can grab these two. I can grab these two and copy them across using control R. So to be able to deal with our circular reference, we can come to file. So come to file within Excel, and then from file come to options. When you click on options, this is going to open this Excel options dialog box where you have information here. When you come here, come to formulas, and under formulas at the right hand side here at the top, you will see enable iterative calculations. All right, so I'm going to check that, and you can see maximum iterative calculations, which is 100. All right, so that is okay. I'm going to hit okay. As soon as you do that, this is going to rectify the circular reference issue. So what you're saying is that Excel should allow this circular reference to actually occur within our model because it is not an error. All right, so I have that, and then I can be able to decrease this to that and copy it across using Control R. Right, and then also interest expense is a negative, is presented by Amazon as a negative figure, and so quickly let's edit this and input our negative sign in front of the reference, and we can copy the formula across using Control R. So that is that for our income statement, I guess. So basically, our income statement is completed. All right. Every other item has been completed within our model. All right. Now let's come to the cash flow statement and see what we can do here as well. So now we can populate the financing activities relating to debt. So the first one is proceeds or repayment of our short-term debts, and that is going to be equal to, let's go to the debt schedule and go to the short-term category, short-term debt category here. And what that means is that we are going to add the mandatory issuance or repayments and the non-mandatory issuance or repayment, which are actually 00. So I'll select this, addition to this. I'll hit enter. I'm going to do the same for my long-term debt and other as well. So equals, come to my debt schedule, and I'll pick my mandatory issuance, which is this, add it to my non-mandatory issuance, which is that, and hit enter. I'll format this as an accounting figure with 0 decimal places, resize this, and copy it across using Control R. Also copy this across using Control R. Then for my principal repayment of finance leases, which is obviously 0 there, for now, we are going to have equals, come back to my debt schedule here, and scroll down to my long-term lease liability section and add the mandatory and the non-mandatory issuances and payments together there, and copy this across using Control R. And then for my principal repayment of finance obligations, this is actually not on our balance sheet, and so we are going to leave it at flat there, or we can once again assume that this is going to continue from the previous period at 271. So I'll hit this and copy this across using Control R. All right. So let's see if there is any other information we have to input here. So with this, we can say that we are done with the cash flow statement as well. So let me send this up to be in line with the historical format. All right. So with the cash flow statement, with this, we can say that the cash flow statement is also completed. Yes. So with that, then let's come to the balance sheet as well and see. So the balance sheet, as we have already done, is already completed, and this is balancing correctly. So as you can see, we are done with our three statement financial model once again. All right. So this has been quite a journey. This is the 8th part of the series, and so we have finished the first part um of our targets. The second part is going to be on valuation. But before then, let us quickly recap what we have done in this particular financial model. So we built a complete financial model of Amazon using 3-year historical information ranging from 2021 to 2023. All right, and we modeled up for a 5-year period that is ranging from 2024 to 2028. Then we modeled the income statement. We made relevant assumptions, and we were able to model the income statement, which is the consolidated statement of operations of Amazon. We have been able to do that. We have been able to determine the basic earnings per share as well as the the diluted earnings per share. All right, so that is what we can see here. Then we moved on to the cash flow statement, and we were able to build the cash flow statement successfully. We have been able to model the various items within the cash flow statement with the help of our PPE schedule as well as the working capital schedule, all right, which we have looked at. And we also looked at the balance sheet. We are able to model the balance sheet successfully, and it is in balance as you can see here. All right, so that is basically what we have done, and this is what we call the three statement financial model or the three statement model. All right, and finally we looked at the debt schedule as you can see here, and voila, we are done. Finally, what I want to do is to select the entire here. So I'm going to select the entire session up to the very end, and per what we do in financial modeling, hard-coded figures are supposed to be input as a blue font figure. All right, so those figures should be formatted in blue font. So that's what we're going to do, and I've already demonstrated this throughout the video. So what we do is to hit F5. Okay, so you can hit the function key F5, and this is going to open the go to dialog box. We come to special, and when you come to special, you see this is go to special. Then we come to constants, and then uncheck texts, logicals, and errors, and hit OK. This is going to select all the figures within this particular schedule, and I'm going to format them in blue font. So I'm going to use this blue here and format that. All right, so just like that, you are able to do just that. All right, so thank you very much for your attention. In my next video, we are going to look at the popular valuation methods we used in investment banking and private equity, and these include comparable analysis, precedent transaction analysis, and discounted cash flow or DCF analysis. All right, so stay tuned to my channel. If this is your first time watching any of my videos, please make sure you have subscribed to the channel so that you can receive new videos when I post them. And also make sure you have watched my previous videos, of which I'm going to leave a link in the video description for you to have access to. All right, so and I'll see you in the next videos.